off to the races. Stocks open for trade officially in the first full week that we've seen of 2025. Bank earnings, of course, will be underway this week. Citigroup will be one of several NYSE-listed banks set to report. And as the week kicks off, I do want to bring in my markets guest here to talk more about what is in store. Joining me now is Todd Sohn, ETF and technical strategist at Strategist. Todd, such a pleasure to have you, and thanks for joining.
Likewise. Thank you very much for having me.
How is the market looking to you right now?
So we think there's very high expectations for 2025, and there's two reasons for that. Number one, S&P 500 performance in 2023 and 2024 was basically a mirror image, right? Up 24% or so. Yet flows to equity ETFs were double last year versus 2023. And so we think that ETFs are this great lens into the psychology of markets, and investors may want to cool their jets a little bit here into the first quarter, first half of the year.
So, of course, correction, a 10% drop, as it technically is defined, many people have always said over history is just a healthy resetting. Do you agree with that?
Yeah, the average year sees about a 14% correction. We haven't had a double-digit correction since late 2023, and so it's part of the process. I still think it's a bull market. Just year three of a bull market can be a much more choppy and challenging than years 1 and 2. So I think you'll want to use this opportunity to perhaps reset, look for where the leadership is, where what emerges out of the correction, but prepare for a little bit more volatility than we've been used to.
What do you expect to be the leadership out of this pullback?
So I would not fade tech necessarily. You still want to have tech exposure, maybe just not overweight tech exposure. And then I'm curious to see if areas like energy and healthcare can finally get some sort of leadership. If you look at flows to those sectors, they have been absolutely deserted. So there's no one there for a contrarian perspective.
Interesting.
So I think tech is still okay, especially the big mega cap names. And then healthcare and energy would be where else I'd look opportunistically.
We'll start hearing from tech companies, major tech companies, right, in the next few weeks when it comes to earnings. The banks behind us always kick off earnings season here for the fourth quarter. That's the earnings season that'll set to get underway here. Comes after Delta had very positive results on Friday, so another sign that the economy certainly is holding up. At these levels, the S&P is probably just 5% from a record high. So between now and throughout the earnings season, how would you describe the events that could unfold based on the charts and the patterns that you see?
Right, it's all about expectations, right? And I think if earnings come in stronger than expected, you'll see a nice little snapback rally back to new highs. What does participation look like? Is it everybody in the pool, or is it going to be the Mag 7? Conversely, if you have worser than expected results, you're going to revisit the 200-day moving average at about 55.30, I think is where it is. That'll get you closer to that 10% level. The average stock will probably be closer down to 15 to 20%, and that's when you get really good oversold conditions, and you take it from there. How does the market eventually respond to that too?
So if the economy is strong, I mean, long term, that would seem like a baseline fundamental that could fuel earnings growth and thus the stock market, right? Can you make that connection? Because our viewers might be wondering, well, why is the market choppy if the economy is so strong?
I think it's about where we've been, right? Back-to-back 20% years is great. But again, historically, year three is very inconsistent. But as long as the big picture earnings are still growing, right? Still forward earnings performance is making new highs, you're in great shape structurally. But I think part of the market process is this ebb and flow of having a correction closer to 15% every couple of years. It's not out of the ordinary, but it's a great time to reset and revisit your portfolio and say, am I too overweight tech? Do I have enough of the other areas that are involved in the portfolio?
What else are you noticing in terms of patterns in this market?
Well, I think what's interesting from the ETF perspective is this focus on super concentrated products, right? All in on the cap spectrum, right? The mega cap names in the S&P 500, on single stock funds, right? Everyone's taking these more highly conviction ideas. Well, we like then the rest of the market to start to pick up then. Maybe we can finally get energy and healthcare and the industrials to participate more fully again. Usually when you start to see issuers issue these new funds in bulk that are focused on a single category, it's kind of a contrarian signal. So we get that sense with this focus on the mega cap type names. It worries me a little bit.
Interesting. Are there sectors that higher yields can benefit?
So energy, materials, real assets. I wouldn't buy just straight energy to benefit off of higher rates, but you want a portfolio that's going to have energy, metals and mining, real estate, and commodities, right? A bulk idea, a bulk portfolio of real assets. There are ETFs that are out there like that. Ticker PPI is one of our favorites. We think you want to take a more well-rounded rather than focusing on just a single sector for higher rates.
We've been talking so much about U.S. stocks, Todd. How do you see international stocks and even emerging markets factoring into this?
So we like Japan. Japan's still hanging in there. The Japanese financials are still very strong, like they are in the U.S. Europe's a little bit more challenged. I think there's a very low bar for Europe because it's been so long since it actually worked. But they're going through some sort of volatile period here, and I'm less enthusiastic about emerging markets because China is just such a volatility burner there. It's far too overweight. It's far too much exposure in the emerging market index. India has now started to correct. That's getting oversold, but I'm a little bit worried momentum has come out of that segment. So I think if you're going to play international, you have to do it actively. Play Japan and play some of these single countries in Europe rather than buying Europe bulk.
Interesting. All right, Todd Sohn, great to have you in the studio.
You.
Thanks so much. Of course, as we get ready to start the week, Todd Sohn is ETF and technical strategist at Strategas.